The big four banks in America have all released their second quarter results, and now it's the turn of the big five lenders who form part of the FTSE 100 index to have their way. Two of that quintet will report their numbers in the coming week, and they are Lloyds on Thursday the 25th of July and NatWest on the 26th. And we'll focus on NatWest in particular in this video, but the trends and issues addressed will apply to the other four to varying degrees, even allowing for their different geographic exposures and business mixes. And they'll be reporting their numbers on, Standard Chartered on the 30th of July, HSBC on the 31st, and Barclays on the 1st of August. The banking sector has shown much improved performance in the past year. The FTSE 350 Banks Index is up by a fifth, to leave it ranked 9th out of the 39 industrial sectors that make up the wider benchmark, and for good measure, the FTSE All Share Banks Index is at a 5-year high. Now, within the big five, Barclays has been the best performer over the past 12 months. And the three lenders with the greatest exposure to the UK have outperformed those where emerging markets in Asia are a greater focus. On the one hand, this perhaps reflects how the UK is emerging from recession, as well as hopes for interest rate cuts, in contrast to the ongoing lack of clarity concerning the economic trajectory of China and Hong Kong in particular, with the former trying to manage a spectacular commercial real estate bust. As we head into second quarter results, however, analysts still seem fairly cautious, because aggregate pre-tax profits across the big five are seen as coming in flat to down in 2024 and again in 2025. For NatWest alone, stated pre-tax profit is expected to drop to £5.1 billion in 2024, down by nearly a sixth from 2023's level of £6.2 billion, owing to lower interest income and marginally higher loan losses. We're going to look again at NatWest specifically, but the themes and numbers to watch will be the same across all the big five, both the second quarter and indeed any guidance for the rest of 2024, namely loan and deposit growth, trend in net interest margin, trend in loan losses and asset impairments, any litigation and conduct costs, and finally cash returns to investors. Now, to quickly take those in order, loan and deposit growth was solid enough at NatWest in 2023, and deposits returned to growth in the first quarter of 2024. The second factor, net interest margin, well, this is where the combination of competition, an apparent end to interest rate increases from the Bank of England, and political and public pressure may mean that the peak is already behind us. That will take a toll on income. In the first quarter of this year, net interest income at NatWest was £2.7 billion, down from a peak of £3 billion in the first quarter of last year. Third trend to watch is loan and asset impairments. A year ago, NatWest booked charges of £153 million, and analysts expect this to reach £171 million in the second quarter of this year. In 2023 as a whole, NatWest's so-called asset quality ratio, the percentage of total loans written down as sour, was just 0.15%, and analysts expect a tiny increase to 0.17% this year. After that, attention will switch to litigation and conduct costs. They were very modest, £24 million at NatWest in the first quarter, and analysts expect just £67 million in the second quarter, compared to £52 million a year ago. All of those factors will shape the headline pre-tax profit number. For NatWest, the consensus is looking for £1.3 billion in pre-tax profit in the second quarter, against £1.8 billion in the same period last year. Finally, then, we will come to cash returns. NatWest bought back £1.2 billion worth of shares from the government in the second quarter, and analysts looking for a first-half dividend of 5.3p a share. For the whole year, consensus is looking for £1.4 billion in buybacks, an unchanged dividend of 17.7p a share in total. And their combined value, well, that will be around £2.8 billion if those forecasts are correct, or nearly 11% of the bank's current stock market capitalisation. As a final point, the Conservative Sunak Hunt administration had planned a major public sale of NatWest shares to further reduce the government stake from around 21%. It'll be interesting to see if the bank's chief executive Paul Thwaite makes any comment on Labour's potential plans or indeed on any other policy issues. The new Labour government is yet to offer anything that can be seen as anti-bank, such as new levies on tiered reserves, which is something that some analysts had feared, for example. Hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.